Hi, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastore. For those of us with a 401k, starting this month, plans are required to include lifetime income illustrations on account statements once a year. The results could be alarming, however, but don't worry, there is more to the story. Here to talk us through the story itself and, of course, what these illustrations are my colleagues, Ainsley Carbone and Justin Waring from the Chief Investment Office here at UBS. Ainsley and Justin, always good to see you. Ainsley, I know we've got a lot to get to today based on a report that you and Justin recently published. We're going to talk about, of course, these lifetime income illustrations, which I think, for the benefit of our audience, we should probably explain what those are. So maybe you can explain that to us.
Absolutely. So what these lifetime income illustrations are aiming to do is it's attempting to help investors like ourselves understand what our retirement assets would look like if we wanted to see it as a monthly income, which of course is a much more familiar and intuitive concept rather than us just looking at a 401k balance on its own. So I want to show you an example.
Yeah, that's perfect. Great.
So up on the screen here, we're showing an example of what you might see for a lifetime income illustration. So Anthony, let's say we have a 401k balance with $100,000 in it. If I'm just looking at that, it's going to be pretty difficult for us to understand what that means for us when we want to spend from it in retirement. So these lifetime income illustrations are helping us translate that account balance into a monthly income. It's essentially saying how much would you be able to get for a monthly income if you used $100,000 to purchase a single life annuity. That's an immediate annuity that would pay out if you were 67 today, and it's a fixed payment. It would be $576.10 per month for the rest of your life. Here we have the qualified joint and 100% survivor annuity, and that is a payment that would, again, immediate fixed payment that's paid to you for the remainder of your life, and then it's also paid once you pass away to your surviving spouse for the remainder of their life. So while these lifetime income illustrations aim to make it easier for us to understand whether or not we're on track to meet our retirement goals, unfortunately, the generic assumptions that are used through these illustrations make it so that we might not be able to have our own personal situations captured through these results.
Right, so it's not really, an individual couldn't look at that particular page and say, okay, that ties perfectly to me. It would depend on everybody's personal situations. And as you just talked about, Ainsley, we are going to get into more of those assumptions that are being made that will help us understand a little bit more about this. And Justin, that brings me to talking to you. So let me ask you, Justin, in your paper, you mentioned that these illustrations may be particularly misleading, as Ainsley and I were kind of alluding to, and maybe even potentially alarming for investors who are younger than age 67. Maybe you can explain why that is.
Thank you for asking that, Anthony. I think it's a really good question. One of the biggest issues with this lifetime income illustration is that it assumes that you're not contributing to your 401k balance between now and age 67. The illustration assumes you're at least age 67. And the other issue is it's not including any growth between now and age 67. So the younger you are, the more inaccurate that these results are going to be. They don't include any growth or contributions between now and age 67. And so that can dramatically underestimate the amount of income that your portfolio will produce in retirement. Because compounding is a really powerful tool for investors. So as you can see on the screen, when we look at continuous contributions over the time, as well as compounding investment returns, your retirement savings can double, quadruple, go even higher over the course of the rest of your working life, so that you'll have a much bigger nest egg in retirement. So since those two major factors are not captured in these illustrations, a lot of investors are going to find that their income illustration is showing them a monthly income that is much less than the amount that they're even adding to their account each month. So if you're a younger investor and you're looking at these lifetime income illustrations for the first time, do not let them deter you from good savings behavior. Every dollar you put into your retirement account will actually be $3 or $4 of retirement spending down the line. It's important for you to put money away early so that you get the most opportunity for growth over the course of your working career, and that will translate into more retirement spending supported by your retirement savings.
Yeah, that's really helpful, Justin. Thank you. And as you're right, it could be seen as misleading if you don't know how to interpret what you're looking at. So, Ainsley, what would you say are maybe some other important issues to keep in mind when reviewing these illustrations? Because as we're talking about these assumptions here and some of the misleading points of this topic, it really would be helpful to see what you're thinking others should be thinking about as they're looking at them.
So first, I just want to start off, there are so many assumptions that we're not going to be able to dive into today, unfortunately. So I encourage everyone to take a look at the disclosures that are listed with your lifetime income illustration. But the number one aspect that I think is important for investors to keep in mind, particularly those who are nearing retirement or already in retirement, is that these payments are fixed. So there are two reasons why that's important to keep in mind and important to just make note of. First reason being that most retirement research shows that retirement spending is not constant. Typically, we spend a little bit more at the beginning of our retirement when we're much more active, and then it tends to go down a little bit because we're not as active, and then rise up again later in retirement because of healthcare costs. So bottom line, retirement spending is not constant, so fixed payments aren't always necessarily appropriate for you. The second reason is inflation. Inflation can completely erode the purchasing power of your fixed income or your monthly fixed income. So as inflation rises, it's going to make the cost of goods and services go up. And as a result, your dollars can purchase fewer goods and services over time. So here we're showing the purchasing power of $100 based on the Consumer Price Index, CPI. And let's say you retired in 1993 and you are living on a monthly fixed income amount. So if you were to retire in 1993 with $100, well, today that $100 would be able to purchase $50 worth of goods and services, worth of stuff. So as you're sitting there and looking at your lifetime income illustration and you're comparing it to what you're making, or what you are spending today, it's really important that you take the time to also compare that monthly income amount to an amount that you would spend later in life. That amount that you spend later in life is not only going to increase due to inflation, but it's also going to change over time because the composition of your spending changes over time. So again, just make sure you're looking at monthly income relative to expenses throughout your whole retirement.
It's amazing to see in that chart that you have up there, Ainsley, how much of an impact inflation really has in just a few years and how retirees should be considering that. Also, this chart is assuming that no further investments are happening with this individual that's represented in this particular chart, correct?
That's correct. It's just showing $100, so it's not assuming that any cost of living adjustments are made or any investment earnings are being applied here, so it's not able to keep up with the cost of living for that reason.
Right. So, Justin, you mentioned that one of the potential benefits of this illustration is that it can help people understand how much income their retirement account balance might produce, which of course is a more familiar and intuitive concept for most people who are watching this today. But your report also talks about the potential pitfalls of putting your retirement into an annuity. So maybe you can talk a little bit about the pros and cons of buying an annuity and how we might think about finding the right balance there.
Yeah, absolutely, Anthony. I think one of the things that is tough about retirement is that you spend your working years building up, growing wealth, getting good returns from the stock market, seeing that balance grow. And then in retirement, you're expected to start to sell your investments and spend your retirement assets down to zero by the end of your life. That's a very uncomfortable transition for many people who are used to seeing the balance grow during their lifetime. An ideal outcome would be just that your company would keep sending you paychecks, and that way you wouldn't have to change the way that you think about investing. You wouldn't have to change the way you think about your lifestyle. You're still living off of the paychecks that you receive. So an annuity has a benefit in that it's giving you a guaranteed lifetime income. Other sources would include pensions or Social Security. These are good things because it doesn't require us to worry about stock market volatility and what we call sequence of returns risk, which is the risk that your portfolio withdrawals will deplete your retirement assets before you're done with retirement. So when we think about how much of that guaranteed income should we be targeting from pensions sources, from annuity sources, from Social Security? I think one major area that we can focus on is taking our spending needs and breaking them into different categories. So you've got discretionary expenses, things like going on exotic vacations and treating yourself. But then there's things that you need to just keep the lights on, your needs. When it comes to targeting how much of your spending should be covered by guaranteed income sources, we generally recommend that you don't allocate more to guaranteed income sources than is required to meet your needs. And the reason for that is because about 90% of the time, you're going to have more income, more spending power if you just invest in the stock market and take the risk that the markets are going to zig and zag. And so while an annuity can help you place a floor on how much you can spend, it also can create a ceiling on how much you can spend, how much you can earn and grow in your retirement portfolio. And so finding the right balance is really going to come down to you and your financial spending needs during the course of your retirement. Another benefit of annuities is that they can help you to hedge the risk that you live too long. So one risk that we're worried about in retirement is that we'll spend our assets before we're dead. And if we have an amount of guaranteed income that's going to be coming into our portfolios for the rest of our lives, that can help us to reduce the risk that simply living too long will lead to that, premature running out of money. And so it is really important for you to talk about this with your financial advisor and discuss with them what are the terms that you can get from annuities in the market, because at the end of the day, one of the main themes of this report is that the lifetime income illustrations are really trying to give us a very basic understanding of how annuity payments might work, but they make all of these assumptions that really kind of understate the amount of income that you might be able to get by purchasing an annuity. For example, they assume that an annuity is only going to give you returns based on the 10-year Treasury yield, which of course is a risk-free rate, and you may be able to do better in the annuity market. So it's really important to talk with your financial advisor, understand what's available for you. Don't forget about Social Security as well. You've already got Social Security that's going to be providing you guaranteed income in retirement. So it's not like you have to also purchase an annuity in all circumstances. That might be enough to cover your needs, for example.
Justin, thank you. Yeah, and I agree with you. The most important thing is really to talk to your advisor. And as you talked about, the wishes, the wants, and the needs, it's also for everybody who's watching this to figure out what those are. And especially as you go further into your retirement age and you're getting older, those may change over time depending on what happens with your personal situation. You have kids who have kids of their own, and that may change your wishes and your wants and your needs. So it's a constant reevaluation. This is a really helpful conversation. Thanks to both of you for doing that. And again, to everyone who's going to see these illustrations on their 401k statement for the first time, we hope we helped you understand a little bit more about how to interpret that and the assumptions involved there. So thanks again to Justin and Ainsley, and thank you all for joining us today. And if you'd like more information on this topic and many others coming out of the Chief Investment Office here at UBS, visit our website at ubs.com/views and follow us on social media, Facebook, Instagram, Twitter, as you can also check out our past UBS trending episodes on demand. As always, as we said, talk to your financial advisor if you have any questions about this topic or anything else we talk about on this show. And until next time, I'm Anthony Pastore. Have a great day, and remember to keep your eyes on what's trending. We'll see you soon. That was great.